P. Evaluate financial performance and determine whether strategic objectives were achieved. Evaluating performance requires comparing actual financial results to pro forma projections and strategic targets. Analysts assess revenue growth, profit margins, return on investment, cash flow generation, and capital structure changes to determine whether strategic goals were achieved. Variance analysis identifies deviations from forecast and distinguishes between operational execution issues and flawed strategic assumptions. For example, lower than expected margins may reflect cost inefficiencies or competitive pricing pressure. Beyond financial metrics, the evaluation should consider whether performance improvements align with stated strategic objectives, such as market share growth or cost leadership. Consistent positive variances suggest effective implementation, while persistent shortfalls may require strategic reassessment. Forecasting financial statements and organizational performance. Csca. Analyze a multi-year financial forecast to estimate relative performance. A multi-year financial forecast projects revenues, expenses, capital needs, and cash flows over several years, reflecting long-term strategic initiatives. Analysts evaluate growth rates, margin trends, leverage levels, and return metrics to assess whether projected performance aligns with strategic ambitions. Comparative analysis against competitors helps determine relative positioning. If projected profitability or growth lags industry benchmarks, the strategy may lack competitive strength or realistic assumptions. The forecast should also be evaluated against organizational goals and capital adequacy. Sustainable performance requires balancing growth with liquidity, solvency, and risk tolerance. Multi-year analysis supports proactive adjustments before financial weaknesses materialize. Financing for growth. Csca. Identify, explain, and analyze strategies for financing planned and unplanned growth and evaluate financing capacity. Organizations finance planned growth, e.g., expansion, acquisitions, R&D investment, through retained earnings, debt issuance, equity financing, strategic alliances, or asset sales. The choice depends on cost of capital, risk tolerance, control considerations, and capital market conditions. Debt financing increases leverage and financial risk but preserves ownership, while equity reduces leverage but dilutes control. Internal financing signals financial strength but may limit liquidity flexibility. Unplanned growth, such as unexpected demand surges, may require short-term financing tools including lines of credit, working capital loans, or trade credit. Rapid scaling may strain liquidity if receivables grow faster than cash inflows. Evaluating financing capacity requires analyzing leverage ratios, interest coverage, liquidity metrics, cash flow stability, creditworthiness, and capital adequacy. Strong financing capacity enhances strategic flexibility and resilience. Characteristics of a successful strategic management process. Csca. Identify characteristics of successful strategic plans. Successful strategic plans begin with objective internal and external analysis, including realistic assessments of strengths, weaknesses, industry dynamics, and competitive forces. A clear and coherent statement of strategy defines competitive positioning, target markets, and value proposition. Goals must be specific, measurable, attainable, and aligned with long-term mission and vision. Alignment with organizational values, culture, and core competencies strengthens implementation feasibility. Strategies inconsistent with internal capabilities or cultural norms often fail despite sound analysis. Strong leadership commitment and clear accountability further enhance execution effectiveness. Transparent communication, effective performance monitoring, disciplined resource allocation, and a sense of urgency are essential. Continuous review and adaptability ensure the plan remains relevant in dynamic environments and supports sustainable competitive advantage. Csca. Discuss differences in strategy implementation across organizational types. Small companies typically benefit from flexibility, faster decision-making, and informal communication structures but may face capital constraints and limited managerial depth. Large organizations possess greater resources and economies of scale but may encounter bureaucratic resistance, slower adaptation, and coordination challenges. Medium-sized firms often balance agility with resource capacity, and for profit organizations, strategy implementation focuses on maximizing shareholder value and profitability, with financial metrics driving accountability. Nonprofit organizations emphasize mission fulfillment and stakeholder impact, often operating under funding constraints and donor accountability requirements. Public companies face regulatory scrutiny, disclosure requirements, and short-term earnings pressure, while private companies may pursue longer-term strategies with greater confidentiality and flexibility in decision-making.